Imagine a company so trusted parents told children to buy its stock forever. A company once valued higher than any other business on earth. A company celebrated in business schools as the gold standard of management excellence. That company was General Electric, and for decades it looked completely unstoppable. Yet today, that same giant exists only as broken pieces and painful lessons. Its legendary name now reminds investors of missed chances, hidden risks, and slow collapse. So what actually happened to this once admired icon of corporate America? How does a company fall from unmatched respect into a warning every investor studies? Stay with the story, because understanding this failure permanently changes how you see markets. It will change how you interpret earnings calls, innovation narratives, and charismatic leadership. Let us begin at the very top of the mountain. During the 1980s and 90s, Jack Welch transformed General Electric dramatically. Under his leadership, the company became Wall Street's most reliable darling. Its market value exploded from tens of billions to over $400 billion. By the year 2000, General Electric ranked among the world's most valuable corporations. Welch was praised for ruthless efficiency, constant restructuring, and relentless performance pressure. Quarter after quarter, the company delivered smooth, predictable earnings like clockwork. Investors loved this consistency and rewarded the stock with premium valuations. Analysts praised it, and business schools treated it as the perfect corporate model. But beneath that polished surface, something fundamental inside the company was quietly changing. General Electric was slowly drifting away from its industrial roots. To understand the collapse, you must understand one quiet but critical decision. General Electric decided it wanted to make money from money itself. This decision gave birth to the powerful internal empire called General Electric Capital. Over time, GE Capital expanded into lending, real estate, and consumer finance. By the early 2000s, it generated a massive share of company profits. This made General Electric appear more profitable and stable than traditional industrial rivals. On the surface, this strategy looked incredibly smart and innovative. The market rewarded the higher returns, pushing the stock even higher. Jack Welch's reputation grew, and his legend became almost untouchable. But this success came with a dangerous hidden cost. General Electric became deeply tied to financial markets few shareholders fully understood. The company's soul began shifting away from engineering toward financial dependence. Its performance now relied on credit markets, interest rates, and short-term funding. As long as money stayed cheap, everything looked brilliantly managed. When that condition changed, the consequences would be severe. In 2001, Jack Welch handed leadership to Jeff Immelt. Immelt inherited enormous expectations and an almost mythical reputation to maintain. He also inherited a massive financial machine intertwined with global credit markets. From the start, expectations for flawless performance were nearly impossible to meet. The stock traded at rich valuations, assuming perfect execution across all businesses. Immelt tried reshaping the company while preserving the illusion of stability. He expanded into new areas and relied heavily on GE Capital profits. Meanwhile, the world around the company began shifting in dangerous ways. After September 11 and the early recession, industrial demand weakened significantly. The image of effortless growth started to crack under real economic pressure. Immelt cut jobs and restructured operations, breaking the myth of endless expansion. Still, the finance arm kept overall earnings looking deceptively strong. Few realized how much risk was buried inside that financial empire. Even insiders struggled to fully understand the complexity of those exposures. The real test arrived with the global financial crisis. Before 2008, GE Capital relied on short-term borrowing heavily. As long as markets trusted the GE name, this strategy worked. Debt rolled over smoothly and operations continued without interruption. When Lehman Brothers collapsed, global credit markets suddenly froze. Rolling short-term funding became uncertain almost overnight. General Electric now faced the same storm as major Wall Street banks. Its financial arm had grown so large it resembled a bank itself. Executives scrambled behind the scenes as funding fears intensified rapidly. The company sought government support and emergency investor capital. Warren Buffett's Berkshire Hathaway provided a crucial high-profile investment. Without these lifelines, the outcome could have been catastrophic. The crisis exposed a brutal truth about General Electric's vulnerability. The finance arm that boosted profits also made the company fragile. Investors began questioning whether GE had lost control of its risks. Trust in management and transparency started eroding steadily. After the crisis, General Electric attempted to pivot back toward industry. Immelt moved to shrink GE capital and emphasize industrial technology again. On paper, the strategy looked logical and responsible. In reality, execution was slow, expensive, and extremely complicated. At the same time, the company made several poorly timed strategic bets. GE invested heavily in gas power generation, expecting long-term demand. Instead, renewables and efficiency rapidly reshaped global energy markets. Power factories built for boom conditions became oversized and underused. The power division turned from strength into a serious financial burden. Shrinking finance operations and weakening power markets damaged investor confidence. Concerns about transparency, debt, and cash flow grew louder. The stock entered a long and painful decline from its peak. By the 2010s, market value had fallen dramatically from historic highs. Shareholders grew angry and increasingly blamed Jeff Immelt's leadership. Critics argued he reacted too slowly and made poor acquisitions. Immelt later admitted mistakes but highlighted inherited structural challenges. Still, the problems ran deeper than any single executive. GE's culture itself had become part of the problem. Pressure to always hit earnings targets discouraged honest internal reporting. Smooth numbers mattered more than confronting uncomfortable realities. Risks remained hidden until they became impossible to ignore. As the decade progressed, GE's troubles became undeniable. Power losses mounted, cash flows weakened, and debt looked alarming. Analysts who once praised GE now warned of serious balance sheet risks. The board eventually made drastic leadership and restructuring decisions. Immelt stepped down and new CEOs attempted stabilization efforts, but fixing a giant burdened by past decisions proved extremely difficult. The narrative shifted from growth ambitions to simple survival. Assets were sold, costs were cut, and focus narrowed sharply. Even core industrial units suffered from years of unrealistic assumptions. Eventually, management accepted something once unthinkable inside General Electric. The conglomerate model itself was fundamentally broken. One central team could no longer manage wildly different businesses effectively. In 2021, GE announced it would split into 3 companies. Healthcare, energy, and aviation would operate as independent businesses. This breakup marked the end of an iconic American corporate era. The healthcare unit spun off first in early 2023. Later, energy and aviation completed their separations. Investors now owned focused companies instead of one sprawling conglomerate. The breakup unlocked clarity and value for individual business units. But it also admitted that the old General Electric had failed. So how did this admired company truly lose its soul? Not through scandal, but through slow accumulation of damaging trade-offs. Financial engineering and complexity overshadowed product excellence and customer focus. First, General Electric drifted away from its original industrial identity. GE Capital blurred the line between manufacturer and financial institution. Calm markets masked this risk, while crises exposed it brutally. Second, perfection pressure, delayed honesty and necessary course corrections. Bad news traveled slowly upward inside the organization. Third, conglomerate complexity became a weakness. In a specialization-driven world, different business cycles pulled a company in conflicting directions. When one unit failed, it dragged the rest down. Investors and founders should ask an important question here. Does your success survive when conditions turn unfavorable? GE chased complexity and growth instead of disciplined fundamentals. The company forgot that boring basics often create lasting value. GE did not fail because it was old or obsolete. It failed because it forgot why it existed. Engineering excellence and customer trust were overshadowed by financial narratives. Smooth charts replaced meaningful long-term resilience. This story warns not only about financial risk but narrative risk. Extreme admiration often precedes dangerous complacency. At its peak, GE symbolized American corporate dominance. Within 2 decades, it faced collapse, restructuring, and eventual breakup. Such falls happen through years of small, compounding compromises. There are quiet lessons every investor should remember. Be cautious when earnings appear unnaturally smooth and predictable. Real businesses experience volatility and uncertainty. Also, understand exactly how a company earns its profits. GE looked industrial but behaved like a bank during crises. Watch how leaders respond when environments change quickly. Delayed action often multiplies long-term damage. Technology transitions can punish even powerful incumbents. GE misread energy trends at a critical moment. Still, General Electric should not be viewed as pure failure. The remaining businesses now have clearer missions and accountability. Aviation remains strong. Healthcare stands independent. Energy refocuses. The soul of GE did not vanish entirely. It was fragmented and redistributed through separation. What disappeared was belief in centralized perfection. So remember General Electric when you see the next perfect company. Remember how confidence masked fragility for years. And ask yourself one final question today. Are you rewarding resilience or just a convincing story? Because eventually, reality always catches up.